Most people operate under the impression that a bank is a monolithic utility, a place where money is stored, and a service that functions roughly the same for everyone who walks through the door. The reality, however, is that the banking system is a series of concentric circles, and the rules of the game shift fundamentally based on the amount of capital an individual represents. There are invisible thresholds, lines in the sand drawn by risk departments and wealth management divisions, where the standard logic of finance ceases to apply. In the retail world, a bank is a place that charges fees for the privilege of holding a balance. In the world of high net worth individuals, the bank is a partner that facilitates the leverage of assets to ensure that cash flow remains constant while taxes remain negligible. Understanding how these systems really work requires a departure from the traditional narrative of saving and spending. It requires an analysis of how institutions perceive risk and how they categorize human beings, not as customers, but as balance sheets. The shift from retail banking to private banking, and eventually to the family office level, represents a total inversion of financial behavior. What is considered a debt for a middle-class household is often viewed as a liquidity tool for those with significant assets. The goal of this analysis is to break down exactly how these mechanisms function and why the system behaves so differently once certain capital thresholds are crossed. If this level of deep dive analysis into the mechanics of wealth and institutional behavior is valuable, consider subscribing to the channel. This space is dedicated to exploring the invisible structures of the financial world, moving beyond the headlines to explain how money and power actually interact behind the scenes. By subscribing, the viewer ensures they remain informed on the patterns that dictate how global capital flows and how the rules of the game change as wealth accumulates. The first major threshold typically occurs around the $100,000 mark in liquid assets. At this stage, the retail bank begins to transition into priority or preferred banking. From an institutional perspective, the cost of acquiring a customer is high, and the risk of losing a customer with a six-figure balance is a direct hit to the bank's deposit base. Consequently, the behavior of the institution changes. Fees that were once mandatory, monthly maintenance fees, wire transfer fees, and ATM surcharges suddenly vanish. The bank begins to assign a relationship manager to the account. This is the first indication that the individual is no longer a number in a database, but a client to be retained. However, the real transformation happens when an individual crosses the $1 million threshold in investable assets. This is the entry point for true private banking. At this level, the standard products marketed to the general public, fixed-rate mortgages, standard credit cards, and basic savings accounts are often set aside. Instead, the institution introduces the concept of the Pledged Asset Line, or PAL. This is one of the most powerful tools in the arsenal of the wealthy, and it illustrates a fundamental divergence in how money is used. In the retail world, if someone needs $500,000 to buy a property or fund a business venture, they typically sell an asset or take out a traditional loan. Selling an asset, such as a stock portfolio, triggers a capital gains tax event. Taking out a traditional loan involves a rigorous underwriting process based on income. In the private banking world, the client simply pledges their investment portfolio as collateral for a line of credit. The bank lends against the value of the stocks and bonds, often at interest rates only slightly above the pattern that emerges here is one of buy, borrow, die. By borrowing against their assets rather than selling them, the individual maintains their market exposure, avoids a taxable event, and accesses liquidity at a cost that is often lower than the rate of inflation or the growth rate of the portfolio itself. The bank is happy to facilitate this because the loan is over-collateralized. If the market drops, the bank has the right to sell the assets to cover the loan, making it a nearly zero-risk proposition for the institution. This is how wealth is maintained and grown without ever spending the principal. As the numbers climb toward the $10 million and $25 million marks, the banking behavior shifts again. This is where the institution moves from being a service provider to being a concierge for global capital. At this level, the ultra-high net worth, or UHNW designation is applied. The primary concern for the bank at this stage is not just the management of deposits, but the orchestration of the client's entire financial life. This includes estate planning, tax optimization, and access to alternative investments that are legally barred from the general public under SEC regulations.
The data suggests that a significant portion of the wealth at this level is moved into private equity, venture capital, and hedge funds. These are Regulation D offerings, available only to accredited investors or qualified purchasers. The logic used by the legal system is that individuals with this much capital are sophisticated enough to understand the risks of illiquid investments. The result, however, is a widening gap in opportunity. While the retail investor is limited to the public markets, where stocks are often priced at a premium, the UHNW individual is given access to the wholesale side of the economy, buying into companies before they ever go public. Institutions typically respond to this level of wealth by offering bespoke lending. A traditional mortgage requires a debt-to-income ratio check, but for someone whose wealth is tied up in a complex web of LLCs, trusts, and offshore entities, income is a choice, not a requirement. The bank's private wealth department will instead perform an asset-based underwriting. They look at the total net worth and the liquidity of the underlying assets. This allows the individual to secure massive amounts of debt for personal residences or luxury assets at rates that are unavailable to the general public. It is also at this stage that the family office structure becomes prevalent. When a family's wealth exceeds $50 million or $100 million, they often stop using a bank's standard wealth management services and instead build their own mini-institution. A family office is a private company that manages the investments and trusts for a single wealthy family. The family office then interacts with banks as an institutional peer rather than a customer. They negotiate lower fees, higher leverage, and direct access to the bank's trading floor. One of the most invisible thresholds in the financial system is the shift in how risk is perceived. For a retail borrower, risk is personal. If they default on a loan, their credit is ruined and their assets are seized. For the institutional level client, risk is often structural. Wealthy individuals frequently operate through special purpose vehicles or SPVs. These are legal entities created for a specific transaction. By isolating a deal or an asset within an SPV, the individual protects their broader balance sheet from the failure of a single venture. This is a level of risk mitigation that the average person simply cannot afford to implement, yet it is standard practice in the upper echelons of finance.
The mechanics of cash flow also change significantly. In the standard economy, people exchange time for money, which is then used to pay for liabilities. In the world of high finance, the goal is to exchange capital for yield-bearing assets, which then produce cash flow to cover liabilities. This is the fundamental difference between being a consumer and being a capitalist. The banking system is designed to facilitate consumption for the lower tiers and capital preservation for the higher tiers. Consider the example of a Lombard loan. This is a form of credit where the bank provides a loan secured by diversified liquid assets. Unlike a mortgage, which is tied to a specific piece of real estate, or an auto loan, which is tied to a vehicle, a Lombard loan can be used for anything. It is the ultimate form of financial flexibility. A person in this position can see a business opportunity on a Tuesday, draw $5 million from their Lombard line on a Wednesday, and close the deal by Friday, all without filling out a single application or waiting for an appraisal. The speed of capital is a massive advantage that is rarely discussed in traditional financial education. The data regarding global capital flows also highlights the use of offshore jurisdictions. While the public discourse often focuses on tax evasion, the institutional reality is more focused on tax neutrality and asset protection. Large amounts of wealth are often held in jurisdictions like the Cayman Islands, Luxembourg, or Singapore, not to hide the money, but to ensure that it isn't taxed multiple times as it moves across borders. For an international investor, having capital sit in a neutral hub allows them to deploy it into various markets, the US, Europe, or Asia, without the friction of intermediate tax layers. Banks facilitate this by maintaining offshore branches that cater specifically to these needs. Another pattern that emerges as wealth increases is the move towards unsecured but highly personal credit. While the average person struggles to get a credit card with a $20,000 limit, individuals with established relationships in private banking often have signature authority. This means the bank will extend millions of dollars in credit based solely on the strength of the relationship and the history of the account. The bank knows that the individual has the assets to cover the debt, so the formal collateralization process becomes a secondary concern. This is the point where the rules of banking become truly invisible. The way interest rates are handled also differs. For a retail customer, the interest rate on a loan is generally non-negotiable, set by the bank's central committee based on the prime rate. For a high net worth client, the interest rate is a negotiation. The spread over the base rate, like SOFR, is determined by the total value of the relationship. If a client brings $50 million in assets to a bank, the bank may offer to lend back $10 million of that at a spread of only 50 or 75 basis points, 0.5 or 0.75%.
The bank is still making a profit, but the client is getting capital at a rate that is essentially the wholesale cost of money. This leads to a phenomenon where the wealthy are actually paid to borrow. If an individual can borrow money at 4% and invest it in an asset that yields 7%, they are capturing a 3% spread on the bank's money. This is known as arbitrage, and it is the foundation of institutional wealth building. While the general public is taught to avoid debt and pay off their mortgages as quickly as possible, the institutional world views low-interest debt as a valuable tool that should be maximized. The more low-cost debt one can carry against appreciating assets, the faster the total net worth grows.
This is also why the concept of net worth is often more important than income in the eyes of a bank. Income is fleeting and highly taxed. Assets are durable and can be manipulated for tax purposes. A CEO might take a salary of only $1, but have a net worth of $1 billion in company stock. The bank will treat that individual as one of their most valuable clients, providing them with unlimited liquidity through pledged asset lines, even though their income on a tax return looks non-existent. The institutional behavior of banks is also heavily influenced by regulatory frameworks like Basel III. These regulations dictate how much capital a bank must hold against its loans. Loans to retail consumers are often considered riskier and require the bank to hold more capital in reserve. However, loans that are fully collateralized by liquid securities, like a POW, are considered very safe. This means the bank can lend more money with less capital tied up in reserves when they deal with wealthy clients. The regulatory system itself incentivizes banks to prioritize the wealthy over the middle class. The invisible thresholds also extend to the legal protections surrounding wealth. As capital accumulates, it is often moved into irrevocable trusts. These are legal structures that effectively separate the individual from their money. Once assets are in an irrevocable trust, the individual no longer owns them in a legal sense, though they may still control how they are invested or benefit from the income they produce. This provides a massive layer of protection against lawsuits and creditors. If a person with $100 million in a trust is sued, the assets in the trust are often unreachable. This is a level of financial armor that is simply not available to those operating in the retail banking world. Furthermore, the way banks handle risk management for their top-tier clients involves sophisticated hedging strategies. If a client has a massive position in a single stock, perhaps they were a founder of a company, the bank can help them hedge that position using derivatives. They might use a costless collar, where they buy a put option to protect against a crash drop and sell a call option to fund the cost of the put. This allows the client to protect their wealth from a market crash without actually selling their shares. Again, this avoids the capital gains tax and maintains their voting power in the company. The relationship between the bank and the client at this level is one of asymmetric information. The bank has access to global research, deal flow, and economic data that the average person never sees. They share this information with their top-tier clients to help them make better decisions, which in turn makes the client wealthier and more dependent on the bank. It is a self-reinforcing cycle of wealth accumulation. The thresholds also dictate how an individual interacts with the real economy. Those in the retail tier are primary drivers of the consumer economy, spending their income on goods and services. Those in the high net worth tiers are the primary drivers of the asset economy, buying stocks, real estate, and private businesses. The banking system is the bridge between these two worlds, but it is a bridge with a one-way gate. It is very difficult to move from the consumer tier to the asset tier because the system is designed to extract fees and interest from the bottom while providing leverage and tax efficiency to the top.
The data shows that this extraction is quite efficient. Overdraft fees, high-interest credit card debt, and mortgage interest make up a significant portion of a retail bank's profit margin. In contrast, the private banking division of the same institution might operate on much thinner margins per dollar managed, but because the volumes are so much higher, it is incredibly lucrative. The bank essentially uses the high-margin revenue from the many to subsidize the high-touch, low-margin services for the few. People in the middle-class position often view their home as their primary asset. However, from a banking and institutional perspective, a primary residence is often viewed as a liability because it does not produce cash flow. The wealthy, guided by their private bankers, tend to focus on commercial real estate or multifamily units. These assets produce rent, which can be used to pay the mortgage and provide a profit. This shift from residential thinking to commercial thinking is another invisible threshold that changes the rules of the game. When the pattern of institutional behavior is viewed as a whole, it becomes clear that the financial system is not a level playing field. It is a tiered hierarchy where the cost of money decreases as the amount of money increases. The risk for the individual decreases as their assets increase, and the flexibility of capital increases as the complexity of the legal structures grows. The information discussed here is rarely found in standard financial literature or taught in schools. This is because the education system is primarily designed to produce workers and consumers, not architects of capital.
The mechanics of pledged asset lines, family offices, and tax-neutral offshore structures are treated as specialized knowledge reserved for those who already have the capital to use them. By keeping these mechanisms out of the public eye, the system maintains its stability. If everyone understood that debt could be used as a tax-free liquidity tool, the tax base for the middle class would be threatened. If everyone understood that banks negotiate interest rates, the profit margins on retail loans would collapse. The patterns of wealth management are governed by a logic of preservation and leverage. The retail world is governed by a logic of consumption and debt. These two worlds exist side by side, often within the same building, yet they operate under completely different sets of rules. The invisible thresholds are not just about the numbers in an account, they are about a fundamental shift in how one interacts with the global economy. The institutional response to wealth is to offer more for less, more service for less fee, more leverage for less interest, more protection for less exposure. This is the money power that dictates the flow of global events. Institutions do not treat people differently because of their character, they treat them differently because of their risk profile and their potential for generating long-term institutional profit. When an individual begins to see the world through the lens of these thresholds, the why behind major economic shifts becomes clearer. Why did the central bank lower rates? To stimulate the borrowing of those with the assets to take advantage of it. Why are tax laws structured with so many loopholes? To ensure that global capital stays within the system rather than fleeing to more favorable jurisdictions. Why does the bank want everyone to have a credit card but only a few to have a Lombard line? Because the credit card generates high interest revenue, while the Lombard line creates a low interest partnership.
The financial system is a machine designed to categorize and utilize human activity in the form of capital. The higher up the ladder one moves, the more the machine works for them rather than on them. This is the reality of banking behavior and money power. It is an observational fact that the rules people live by are dictated by the thresholds they have crossed. The reason these concepts are rarely discussed in an open forum is that they challenge the narrative of the universal financial experience. Most financial advice is predicated on the idea that everyone is playing the same game, just at different scales. But as the data suggests, the game itself changes. The goals change, the risks change, and the winners are often those who understand the invisible rules of the institutional world long before they ever reach the thresholds required to use them. Understanding these mechanics is the first step in recognizing the patterns that govern the modern world. It is about seeing the invisible lines, the hidden costs, and the true nature of the relationship between the individual and the institution. The system is transparent to those who know where to look, but for most, it remains a series of locked doors. The goal of this channel is to continue opening those doors, providing an analytical and observational look at how wealth and power really operate. The structures of finance are not just about numbers, they are about the invisible thresholds where the rules of the world are rewritten. By looking at real-world examples and the way institutions typically respond to different levels of capital, a clearer picture of the global economy emerges. It is a world of tiered access, strategic leverage, and the constant quiet movement of capital toward the path of least resistance and greatest protection. This information is often kept within the confines of private boardrooms and high-end wealth management offices because it is the operating manual for the global elite. It is the set of instructions for how to navigate a world where money is no longer a medium of exchange, but a tool of influence and a shield against volatility. By observing these patterns, one gains a deeper understanding of the forces that shape the rules everyone lives by, whether they are aware of those rules or not. The financial system doesn't just store money, it dictates the terms of engagement for the entire world. And those terms, as we have seen, are anything but equal. The patterns that emerge from this analysis suggest that the divide between the retail and institutional worlds is only growing. As technology allows for more sophisticated financial engineering, the thresholds are becoming even more defined. The data points toward a future where access to these specialized banking behaviors becomes the ultimate form of wealth. It is no longer just about how much you have, but about which circle of the system you are allowed to inhabit. The institutional logic is clear. Reward the concentration of capital with the tools to concentrate it further. This is the feedback loop that governs the banking world. It is the reason why the rules for the many are so different from the rules for the few. This analysis serves as a window into that reality, breaking down the invisible thresholds that define the true nature of money, banking, and financial systems. The silence surrounding these topics is not accidental. It is a feature of the system. The more people who view banking as a simple utility, the more effective the utility is at performing its primary function, the management of risk and the extraction of value.
But for those who observe the patterns, the banking system is revealed to be something much more complex, a multi-tiered architecture of power designed to treat individuals exactly as their balance sheets dictate.
The rules are not hidden in the sense that they are illegal or secret. They are hidden in plain sight, buried under layers of jargon and institutional procedure. But when the jargon is stripped away, the reality is simple. The more capital an individual controls, the more the financial system becomes an ally. The less they control, the more it becomes a predator. This is the fundamental truth of the financial world, and it is the key to understanding how wealth and risk truly change the rules people live by. In the end, the invisible thresholds of the banking world are the true borders of the modern global economy. They determine who can move freely, who can borrow cheaply, and who can protect their legacy. These are the rules that govern the behind-the-scenes operations of finance, and they are the rules that this channel will continue to explore and explain. Understanding these thresholds is not just about finance, it's about understanding the hidden architecture of the world itself. This information is rarely discussed because it reveals the true nature of the financial